Welcome back to the stream, ladies and gentlemen. As you guys can see, we got shorted. Maybe the Federal Reserve did not like what we had to say. Maybe the plunge team decided to short our stream. Not entirely sure. All right, here we go. Now, this isn't just something that happened in 1929. This also happened in 2008 during the financial crisis. Oil prices are down from $97 last Thursday to less than $85 a barrel today. And in 2008, we saw the same sort of collapse occur in utilities than we are right now. All right, welcome back, everybody. Appreciate y'all, and thanks for rejoining us here. So as you can see here, the 2008 financial crisis and Great Recession induced a bear market in oil and gas, sending the price of oil from $133 to $39 in just less than 1 year. And in 1 week, we've already seen the price collapse from $97 to $85. The recession led to a general drop in asset prices around the world as credit contracted and earnings projections fell. That's the exact same thing we're seeing right now with credit contracting, with the interest rates rising, banks lending less money because of that and the fact that they're losing more because of the rising interest rates, and the reverse repurchase program contracting from over $2.5 trillion just a few months ago now sits today at $1.2 trillion. That's over a trillion, $1.2 trillion that has actually been sucked out of the reverse repurchase program in just the last 3 months, basically, which is huge. Huge. Check it out. Oil prices fell from $133 to $39 in from June 08 to February of 09. Over that same time period, natural gas prices fell from $12.69 to $4.52. The lower price for oil and gas due to the financial crisis was the major impact on the sector. We started to see the same thing begin right now, and we saw the same exact thing happen in 1929 as well. Now, what other utilities are crashing right now? Well, transportation. Shares of French train maker Alstom crashed by 38% today. Alstom has bonds that fell by the most on record today following their disclosure of preliminary financial information, which we're looking at now. They indicated a significant decline in free cash flow projections attributed to rising inventories. The results showed that Alstom's free cash flow had plunged from negative 45 million euros, negative 45 million, to negative 1,150 million euros. They expect a negative 750 million euros for the full year, compared to earlier forecasts that were significantly positive, basically. So what they're seeing right here is their balance sheet going from negative 45 million to negative 1.15 billion is absolutely huge. It shows you that the company, Alstom, with the world's largest portfolio of components of the rail sector, is a huge red flag. Now, Deutsche Bank is telling clients that this is a major blow to the top executives' credibility, and they see a capital increase that's increasingly likely, meaning they're probably going to get margin called at some point and be forced to raise equity to do dilution. This is the biggest one-day crash for Alstom of negative 35% in 1 day that they've seen in the last 20 years. And their bonds also sank 3% on top of that as well. So you can expect government intervention from the French government on that aspect as well. As we touched on earlier, 30-year fixed mortgage rates right now are at 8.6%. This is the highest that we have seen in 23 years, in case you're unaware. So housing unaffordability is going to get even higher. And then you've got Japan. Japanese 30-year bonds are down 20 basis points in the last hour. And why is this? Because Japan is selling United States treasuries and buying their own bonds as a form of basically bailouts. It's their plunge team at work. They are performing unscheduled bond buying operations to maintain the yen from going over 150, 1 to 150 US dollars, and to bring down their bond yields. And it seems they succeeded. So for the Japanese 30-year government bond yield to go from 1.84 to 1.66 over the last 1 hour, I would suspect that they spent billions, if not hundreds of billions of yen, buying back their own bonds in order to prevent a financial collapse within the Japanese system. Japan has absolutely no fucking idea what they're doing, if you ask me. They're throwing shit at the wall because they are absolutely desperate. On top of that, this is a systemic global problem that we're seeing in real estate. In China, you're having the largest developers like Country Garden, Sunac Holdings, Evergrande go insolvent and bankrupt right now because the Ponzi created there can no longer be kept up. Nobody else is buying or pre-purchasing their apartments. That's what goes on in China, by the way. You have to pre-purchase an apartment or a home or a condo, mostly condominiums, in order to receive one, and you get it a few years down the line. But because nobody's buying them from these companies because they're going bankrupt, we're looking at their mortgage-backed securities and commercial mortgage-backed securities collapse. This is something that stems all the way across the world because your bank, your ISDA bank, likely holds hundreds of millions in Evergrande and Country Garden and Sunac bonds, and there's 150 other commercial real estate developers in China undergoing the same thing. Now here in North America, we're also seeing this happen in Canada. Okay, you guys might not be aware, but Canadian households right now are experiencing negative amortization on their mortgages, over $32.8 billion worth. What does this mean? This means that they're paying their mortgage every month and their balances are going up, ladies and gentlemen. So imagine you just paid your $2,000, $3,000, $4,000 a month mortgage or more. And instead of watching your balance come down, your balance is going up because you can't even keep up with the interest rate payments alone. So how many families do you think are going to stop paying their mortgages as the value of their homes drop, as these residential and commercial mortgage-backed securities from China to Europe to the Americas are all collapsing at the same time? And as the bonds for Evergrande and Credit Suisse and these banks and everything in between start to collapse as well, their equities are going to lose. They're going to lose major value in the actual value of their home. They're going to lose a lot of money in the actual value of their home, and their equity is also going to be depleted. One, because the interest rate is eating it up like Pac-Man, and two, because the actual entire value of that home is going to be collapsing at the same time. This is a huge risk to the real estate market and to the value and equity that you have in your home all around the world. So this is an absolute real estate crash in the making, if I've ever seen one. And for those of you that are unaware, I was a realtor back after the 2008 collapse from 2010 onwards, and it was nasty. It was nasty. I think I've told you guys in 2010, I rented over 53 apartments in that 1 year, and I sold one house because nobody was fucking buying. Nobody could afford to buy, and people were desperate to rent. 20% of residential mortgage borrowers in Canada, over $130 billion worth of loans at 3 banks alone, just BMO Harris, TD, and CIBC, are seeing their balances grow as their monthly payments no longer cover all the interest that they owe. This is negative amortization. And BMO disclosed that mortgages worth $32.8 billion were experiencing this negative or amortization just in this one bank. Imagine how many thousands and thousands of people are being affected by this right now. And I think it's only a matter of time before a lot of them turn in the keys, file bankruptcy, and get an apartment, because it saves them so much more money than having to constantly lose money to live in the home that they currently live in. Because Canada, unlike the United States, doesn't have 30-year fixed mortgages. They have 5-year balloon rates. And a lot of the people have to refinance in the current market, whether they like it or not, because their balloon rate is over and they have to refinance at the current existing interest rate. And as I just showed you, that's over 8.6%. And shit, that's if you have a good credit score. And that's for a 30-year fixed. Might be 8.0% if you have a 15-year, or 7.5% if you have a balloon rate, but it's not going to be good either way if you were previously paying 3%. This is a sign of how the Federal Reserve is destroying the housing market and creating inflation. They are not considering rising home prices as inflation. This is the disconnect of home prices from rent, OER, and CPI here. This is the rent of primary residence in yellow. This is CPI in green. And this is the national in dark blue, national home price. And this is the 10 major cities in the United States. As you can see, they're greatly elevated from inflation. And by separating the weight, W-E-I-G-H-T, of rent and home ownership from the CPI, they're artificially making CPI look as if it's lower than it truly is. The Case-Shiller Index, which is what this is, the Case-Shiller National Top 10 Metro CPI Owners Equivalent Rent, measures the repeat sales of the same home over time. All right, so for 12 years, they all rose together through here. And that changed in the year 2000. And then they had a retouch in 2012 after the collapse. So you can see how the bubble grew during the 2006, 7, and 8, and then started to collapse and came down to meet CPI. If we do the same here, you can sure as hell bet that we're going to see something very similar here with home prices and rents collapsing back down to meet CPI again. So the Fed was really doing round after round of quantitative easing and suppressing mortgage rates to allow this to happen back in 2000, from 2000 through 2007. And they've done the exact same thing from 2011 through today. And they can no longer do that. These are mortgage payments. Mortgage payments compared to wage-adjusted mortgage payments. All right? Basically, if the 12-year trend of home prices rose with the average hourly earnings, the home price index would be much closer to like 211, much lower than it currently is. As you can see here, it's over $3,700. And this does not include interest and property taxes. So let's move on. Basically, in short, when you factor in wage growth, home prices and mortgage rates, homes are the most expensive that they have ever been in history. And when you look at the Case-Shiller Index, the bubble that we're in now is more than double that what it was back in 2007 and 2008. Then you've got the issues going on with Canada's housing market, and then China and Germany and the rest of Europe. And ladies and gentlemen, we're in for a global recession. But there's good news. Certain assets, like silver and gold, while they are moving downwards in value, the prices are declining over the last several months. Their performance has been extremely strong considered the sharply rising real interest rates. This is measuring the gold's performance against real rates, which is the TIPS yield. So this is the 10-year TIPS yield in blue, which has collapsed down to 700, and the US dollar gold price, which is currently in the mid 1800s, down from its high of around 2000 and change, but still remaining elevated and has not crashed along with the TIPS yield. This is a chart from 2006 all the way through today. So the gold price has been set by Western banks for over 100 years. Precious metals are traded in dark pools over 97% of the time, okay, in case you didn't know, because they are greatly suppressed from going up and they are greatly suppressed from going down as well. So from 2006 through 2022, as we're seeing here, there's a tight inverse correlation between the price of gold and the 10-year TIPS, the Treasury Inflated Protected Securities, and this reflects real interest rates. And then take a look at this chart. This is a more zoomed in chart from January of 2018 through today, 2023, and look at what's happening. You can see here in early 2022, things when we started calling for the devaluation of risk assets, the stock market, US dollar gold price came down slightly and then remained elevated, actually went up as the TIPS went down. So when the West froze Russia's dollar assets, gold started continuing higher than the price previously suggested through the TIPS model. Dollar assets like stocks and bonds became much more risky, and it was never really sustainable to begin with because it is a Ponzi. That's why investors have moved into gold, central banks have moved into gold, and this is a more permanent change, in my opinion, than people expect. So it's showing phenomenal strength against real rates right now. So the West, in my opinion, is now losing control over the price of gold because countries like China and Europe and such are absolutely scooping up tons and tons of gold. Right now, China has over 5,000 tons of gold. 5,000 tons, ladies and gentlemen. And last month in September, we saw a 32% increase in the premiums on gold relative to real rates. So that's definitely bullish for precious metals. Take a look. Now, in one day, Joe Biden has increased the debt of the United States by $275 billion. The U.S. added yesterday $33 billion more debt, bringing the two-day total to $308 billion with a B. And just 15 days ago, the United States crossed the $33 trillion mark, and they've added another $500 billion in those 15 days alone. That's $1.4 billion per hour. Per hour. They couldn't build a $5 billion border wall, but they can add $500 billion in debt in 15 days. They can give illegal immigrants $2,200 a month in perpetuity for the rest of their lives. Free housing, free cell phones, free health care. Do you get any of that? I didn't think so. The debt to GDP ratio in 2020, during the Ponzi money printing that was occurring, was only nominally higher than it currently is now, the debt to GDP ratio. And we're going to see $34 trillion here way before the end of October. Way before. We'll probably see that in the next 15 days. And you know what? Excuse me. They bring up a great point. Imagine what happens if a recession hits. Imagine what's going to occur. So as you can see here, the Copassai letter here, just 2 days ago, the U.S. added $275 billion in one day due to Social Security payments due at the end of the fiscal year. And since the debt ceiling crisis ended, Biden and company removed the debt ceiling till like 2025, they've added over $2 trillion in debt. And they want to claim that they're able to bring inflation down. No, this $2 trillion in debt is artificially propping up the GDP of the United States. If you take anything away from this stream, aside from everything else that I've told you, is that the United States economy and the global economies are not strong. They're being propped up artificially by the printing of money in the form of government spending. $2 trillion in debt has been added. Now, Congressman Greg Stoib brings up a great point. Why are we prioritizing sending hard-earned American tax dollars to foreign countries that are completely corrupt and hate America? He says no more money for Iraq, no more money for Lebanon, no more money for Ukraine. It's time to put America first. And the guy's right.
And it's very interesting to me to stand up here and listen to my colleagues who talk about cutting spending and that we have a deficit and that we have a spending problem in Washington, and they would rather prioritize monies to Iraq, to Lebanon, to Palestine, to Ukraine over the needs that we have in this country. It's just, the people in my district don't understand it. When I talk to people in my district, they don't get it. They don't understand why we would prioritize sending our hard-earned tax dollars to countries that are completely corrupt and hate us with no assurances that it's going in the places that it's going. Why would we do that? I just don't understand why we would stand here in the current economic situation that we have in this country and send money to foreign governments that hate us and try to kill us. I yield back. And it's
unfucking real. Unfucking real. That's why right now you're seeing countries like Iraq and BRICS Plus banning all cash withdrawals and transactions in the US dollar by January 1st of 2024. The Central Bank of Iraq says that people who deposit US dollars into banks before the end of this year will be able to withdraw those dollars next year. However, dollars deposited after January 1st will only be available in their local currency of dinars at the official rate of 1,320 dinars for every $1 US. So they will no longer allow people in Iraq to use the US dollar. And they claim that the move is meant to crush money laundering and the illicit use of money, US dollars, because 50% of the Iraq imports in cash each year on cargo flights from the Federal Reserve go to illicit uses. That's over $10 billion per year. And they go in and they're shipped over to Iraq twice a month. All right. There are over $100 billion in reserves held by U.S. banks that Baghdad relies on the goodwill of the United States and officials to ensure that the economy doesn't collapse. And that's happened since 2003. Gee, I wonder why they were after Saddam. All Iraqi oil revenues have been paid into an account with the U.S. Federal Reserve, which allows Washington to control the Iraqi economy and put pressure on their government. So the United States last month refused to approve the transfer of an extra $1 billion in cash to Iraq from their very own oil sales proceeds. Therefore, Iraq and BRICS Plus are all saying, no problem. We're going to move on to our own dollars. Take a look at this. This came out September 1st, and nobody is talking about it. Nobody. This came out from the Congressional Research Service, and I'm astounded that nobody has brought this up. They say that banks' unrealized losses are absolutely massive. They are implementing new bank capital rules and requirements for banks with over $100 billion in assets because they're so over leveraged. So this proposal would implement what is popularly called as the Basel III Endgame, which is a series of reforms from the Intergovernmental Basel Committee on Bank Supervision. The proposal would make a number of other changes, including some responding to the problems raised by the failure of Silicon Valley Bank in the spring of 2023. They discuss how the proposals would change the capital treatment of unrealized losses on the debt securities that banks hold as assets. And then part 2 discusses recent policy concerns with the rapid growth of these unrealized losses at banks and the role that they played in the collapse of SVB as well. This basically means that there are going to be even tighter margin capital bank requirements and margin requirements than we're currently seeing now. They argued that unrealized losses could materially affect a banking organization's capital position, and associated risks should therefore be reflected in its capital ratios. So they faced criticisms from banks that this treatment would cause capital levels to be too volatile, and the final rule that was applied, the requirement only to advanced approach banks at the time, banks that had over $250 billion in assets or a $10 billion in on-balance sheet foreign exposure, because other banks that did not meet these requirements could opt out. So this proposal would extend requirements to any U.S. bank, BHC, or international holding company with over $100 billion in assets, significantly lower than previously. So this would increase the number of banks subject to the new capital requirements from 9 banks up to 36 banks. Again, capital will be tighter. There will be less money in the system, less money being lent out, higher interest rates for longer, and more margin calls so that these banks can maintain their requirements. This comes directly from the Basel Committee on Bank Supervision. So as you can see here, recognizing unrealized gains and losses would lead to higher capital in some years and lower capital in others for banks overall. But unrealized losses have increased rapidly beginning in 2022, equaling $232 billion on AFS securities available for sale, for those of you that don't know, and $284 billion on HTM, which is held to maturity securities in the first quarter of 2023. This compares to only $4 billion in realized losses in the first quarter. So out of that almost $600 billion in unrealized losses, only $4 billion was realized in the first quarter of this year. And look at what's happening to banks. Look at how many banks are already starting to collapse. So this only partially addresses the current problem, they say, and it does not apply to unrealized losses on held to market securities, held to maturity securities. The rationale being the bank does not intend to sell those securities, which account for over half of banks' unrealized losses. So banks of all sizes have experienced unrealized losses. Community banks had unrealized losses of almost $60 billion in the first quarter of 2023, and their securities holdings are comparable to other banks at 22% of total assets. Again, here we have the same chart that I showed you guys earlier with the massive decline in unrealized losses beginning just in 2022. And if you've been watching this channel for any extended period of time, you know that we were talking about this in July and August of 2021 as these numbers started to turn downwards before anybody else, because I've had my eyes on this for years as a business owner, because watching these levels and this data from the Bureau of Economic Stability and all these congressional research services allows me to figure out what the landscape in business is looking like over the coming years. Anyways, I'm not going to read all of this, but I will say this. It says that these unrealized losses threaten a bank's solvency only if it sells securities, as was the case for SVB. The proposal to hold capital against those losses reduces the threat to solvency. But if the securities are never sold, then the banks will never realize losses related to interest rate movements that reduce capital, although low-yielding assets will weigh on profitability. Higher interest rates affect bank profitability through multiple other channels as well. If interest rates banks charge to customers rise more than the bank's interest expenses, overall profitability could rise. But in that case, additional capital would be necessary. For the overall industry, net income and net interest margins were relatively high in the first quarter of 2023. Unrealized losses are not a solvency concern if banks have effectively hedged that risk by purchasing interest rate swaps. However, one study by the Congressional Research Committee found that 75% of banks do not use swaps. And hedging declined even further in 2022 when rates rose. Only 6% of industry assets are hedged. So we just got them told that there's no threat to them if they are hedged with interest rate swaps, but 75% of banks don't use swaps at all, and only 6% of the industry assets are actually hedged. Ladies and gentlemen, banks are fucked. 75%. And at the same time, you've got pieces of shit like Patrick McHenry receiving millions of dollars. Pieces of shit like Representative Huizenga receiving millions of dollars from market makers to defund the Securities Exchange Commission and prevent them from receiving funds and using funds to enforce market reform. Members of the House Financial Services Committee have decided to listen to a small group of powerful firms like Virtue, the market maker, Citadel Securities, the market maker, other broker-dealers, big banks, etc. And they're trying to stop the Securities Exchange Commission from doing anything to fix market structure. They are including in this language, all this language in the fiscal year 2024 final appropriations bill. They state that none of the funds made available by this act may be used by the SEC to finalize, implement, or enforce the rulemaking entitled Regulation Best Execution, Order Competition Rule, and Regulation NMS Minimum Pricing Increments, Access Fees, and Transparency of Better Priced Orders. Basically, short sale regulations, reducing payment for order flow, and increasing orders going to lit markets is not what market makers and big banks want. They are actively campaigning by giving guys like Chuck Schumer, Patrick McHenry, Bill Huizenga, Carolyn Maloney, hundreds of thousands of dollars every single year in lobbying and contributions. Every fucking year. That's millions and millions of dollars over the course of several years per institution. There were 9,073 companies that lobbied in 2022, and Virtue Financial only ranked in the top 1,200. And they gave over $500,000 in 2022. And they only ranked in the top 3,500 out of 30,777 contributions, giving over $124,000 in 2022 as well. One of the main recipients being Patrick McHenry. He is the chairman of the Financial Services Committee. And they are actively voting against stock market reform. Okay, the order competition rule, regulation best execution, yes, getting the best pricing and saying fuck payment for order flow is the opposite of what Congress wants. Stop the madness against constituents and the American people. We need Wall Street reform. I'll put a link at the end of this video where you can reach out to input your zip code and call your congressman, because this is still being voted on and we still have a chance of getting this reversed and getting this removed from the 2024 appropriations bill, especially if we got based motherfuckers like Matt Gaetz at the helm that are over there campaigning for the American people. No. That being said, why is this a big deal? Well, it's a really big deal. because in 2020, Robinhood was forced to pay $65 million in fines because the Securities Exchange Commission found that retail investors lost over $34 million via payment for order flow in these commission-free trades. None of those trades were actually free, ladies and gentlemen. Just because you don't see the amount of money that they're taking from you doesn't mean that you're not paying a fucking commission. Every share you bought had a markup via payment for order flow that went to Robinhood. And you lost $34 million more as Americans trading on Robinhood than if you would have gone and just paid a couple bucks a trade from a non-payment for order flow broker-dealer. And Robinhood did not have to admit guilt. Ken Griffin in 2004, you can see what he was saying about payment for order flow. He said it lacks transparency and it is anti-competitive and it creates an obvious and substantial conflict of interest between broker-dealers and their customers, and that the government should ban payment for order flow altogether. Bernie Madoff created payment for order flow, and now Ken Griffin and Citadel Securities, one of the world's largest broker-dealer, if not the world's largest broker-dealer and market maker, consistently and daily uses payment for order flow through broker-dealers like Robinhood and Webull and such to make money off of you and front-run your trades and run your orders through dark pools and trade them over the counter so that your dollars have almost zero material impact on the stock price that you're buying. You don't control the price as long as payment for order flow is occurring. You don't have a say in changing the price of a stock even for a second if your orders are not going direct to lit markets. Since then, obviously, he's changed his stance, and they are one of the biggest proponents of payment for order flow now, as well as Virtue Financial, Dougie Sifu, the liquidity fairies, and they're paying a shitload of money to Patrick McHenry to prevent reform on Wall Street. Unreal, huh? They're defunding the Securities Exchange Commission, and they're trying to make Gary Gensler look like a bad guy. Yeah, he used to work for Goldman Sachs. But look at our alternatives. Our alternatives are Hester Pierce and the rest of the board of the SEC, which, as you can see, even the committee chairman of the Financial Services Committee is in the pockets, and Congress are receiving money all the time from these broker-dealers and market makers. IBKR, Interactive Brokers, just paid $35 million in fees for illegally deleting communications. There was over $79 million in fees charged to 10 different Wall Street firms for widespread record-keeping failures. IBKR paid $35 million. Robert W. Baird, I believe of Baird & Warner, agreed to pay $15 million. William Blair & Company of William Blair Investment paid $10 million. Nuveen Securities, $8.5 million. Fifth Third, the bank, Fifth Third agreed to pay an $8 million penalty. And Perella, Tudor, and a bunch of others paid an additional $2.5 million in penalties. As described in the SEC's orders, the broker-dealer firms admitted that from at least 2019, their employees communicated through personal text messages about the business of their employers, and the investment advisor firms admitted that their employees sent and received off-channel communications related to recommendations made or proposed to be made and advice given or proposed to be given. They did not maintain or preserve the substantial majority of these off-channel communications, of course, because they knew that they would just receive a small slap on the wrist compared to the hundreds of millions, if not billions of dollars that Wall Street was making off these record-keeping violations. Now, of course, Robinhood, we can't leave them out again. You saw that they just paid 2020, they just paid $65 million. Now today, this just came out on September 29th. Robinhood Markets agreed to pay another $100 million in legal and regulatory fines. But the mainstream media conveniently omitted the offenses that were committed to receive the fines. I've gone in and I found all the offenses, obviously, but that's not really the point here. There's a bunch of offenses that occurred. And they have to resolve these legal and regulatory matters that they say were previously disclosed over the course of 2023. Again, another $100 million on top of the $79 million outlined below. The SEC is just taking their cut. Congressmen and the committee, the Financial Services Committee, are just taking their cut. And I have had enough. That's why we're working on Lit Exchange. Lit Exchange is not a licensed broker-dealer yet. And we will be coming to you in the future with more information on our Founders Program. But as of now, this is not an offer or a solicitation to buy, hold, or sell any security of any kind. But you can go to litexchange.com to input your email address to get updates in the very near future, should you want them. If you guys want to stick around, we can talk about AMC for a little bit. If you guys really want to talk about it, we can definitely do that. The macroeconomics and geopolitics portion of this stream is over. How about you guys here in the voice chat? You guys have anything you want to talk about? Because, oh boy, AMC is looking really fucking sexy right now, even though a lot of people are unaware of that. Their stock is really looking good. But really, I want to briefly say, look at the $1 trillion over the last 6 months that's being drained out of the RRP. Over $1 trillion. Over 500 billion. I'm sorry, 100 billion in the last 7 days alone. $100 billion has been drained of liquidity from the banking sector in the last 7 fucking days. This was up at a high of $2.55 trillion, and it is now today it was $1.2 trillion. We are going to see one of the greatest stock market crashes in the history of the world, in my opinion. What's going on, guys? You guys got any questions? Feel free to drop them in the chat. I'm looking at YouTube chat. I'm looking at Discord. I hear you guys here. I got all you guys here in the think tank with me. Let's hear it. Let's hear it. Bring it on, guys. You know what? I'll get us started. All right? You want to talk AMC? Let's talk AMC right now. Check this out. AMC distribution has surpassed $100 million in pre-sales of in revenue from the Taylor Swift The Eras Tour concert. And they still have an entire week to go. Holy shit. Taylor Swift and AMC Theaters, as the exclusive distributor of the movie, are going to make hundreds of millions, if not billions of dollars off this one fucking movie. This is wild. And then we've got Beyonce coming in December too. And this hasn't even started airing. This doesn't even begin until October 13th is the first fucking day. And they're going to be showing Taylor Swift concert in over 100 countries around the world. Demand in the United States was so huge that Taylor Swift and AMC decided, hey, let's go worldwide. And it's going to be shown in over 8,500 theaters around the world beginning October 13th. And it's already crossed that mark. Now, take a look at this. I see a lot of stocks here. Nike, CVS, Target, Starbucks. And they're down big time from their all-time highs, ladies and gentlemen. Look at this. Nike's down 47%. Ulta is down 28%. Bros is down 70%. VFC is down 83%. Goose is down 81%. Whereas even Kohl's is up here too. I saw him just a minute ago. Starbucks down 28%. Target down 60%. GPS down 80%. M is down 84%. Holy shit. Now, what's the difference between all of these blue chip and retail stocks and AMC stock? Well, AMC stock is down fairly significantly as well, right? But there's some major differences here. Let's talk. Only AMC has over 4 million retail investors that are diamond handing the shit out of that stock. Only AMC. Only AMC has an on-balance volume of over $12.2 billion. Got it? Only AMC retail investors own more than 85% of the entire available share float. And if you ask me, we probably own the float several times over, hundreds of times over, not hundreds of times, but hundreds of percentages over the actual available float when you take into account all of the synthetic shares that are out on the market. Oh, but you could leave that as speculation. AMC share counts, of which AMC has completed 4. For those of you that are unaware, AMC has already completed 4 share counts. The most recent one was several years ago, but at the time we found out that retail investors owned 85% of the entire float. And that being said, that meant that every retail investor only had like 100 shares of AMC, and that was pre-split. So do you own more than 10 or 15 shares of AMC? Because if you do, then you own a higher percentage than expected. Only AMC stock owns a fucking gold mine named Highcroft Mining Corporation in partnership with Eric Sprott, the owner of Sprott Physical Silver Trust, PSLV. Only AMC is partnered with Taylor Swift and Beyonce and has $100 million in pre-sales for the Taylor Swift concert over a week before the concert has even begun airing in 8,500 theaters in over 100 countries. Only AMC has a quarterly revenue that exceeds their entire market cap by over $1 billion fucking dollars. AMC's whole market cap is like 1.3 billion right now. Their entire market cap is maybe 1.3, 1.4 billion. And this quarter alone, AMC stock, AMC Theaters, is poised to make over $2.5 billion in revenue. Maybe way more than that with the way that these Taylor Swift concert is going. Only AMC is partnered to issue their own credit cards with Visa and is partnered with Walmart and sells their popcorn in over 2,600 Walmart retail locations nationwide. Only AMC has recently, over the last couple of years, paid off billions of dollars in debt, opened 50 new locations, and has a CEO that meets in person with their retail investors at various locations throughout the year to answer questions directly from retail investors. Only AMC. This is the planet of the apes. Oh my God, guys, AMC has like $5 billion in corporate debt. Oh my God. Oh, really? Did you know Ford has $100 billion in corporate debt? And GM is $73 billion in corporate debt? Did you also know that GM is now recalling millions and millions of vehicles because they are having yet another airbag scandal? If you guys heard about the Takata airbag scandal of 10 years ago and tens of millions of vehicles were recalled, just today, GM stock is down big time because they have to recall millions and millions of vehicles again, and GM saw a massive decrease in their share price because of another airbag scandal. Did you know that CVS has $71 billion in debt, and Rite Aid has tens of billions of dollars in debt as well and is closing tons of stores? What about Coca-Cola? They have $25 billion in debt. General Electric, $95 billion. Dell, $49 billion. Comcast, Verizon, and AT&T, $105, $107, $166 billion in corporate debt. Ladies and gentlemen, having $5 billion in corporate debt is no big deal, especially when out of all these companies that you see here on this list, AMC is the only one whose quarterly revenue exceeds their entire market capitalization. Got it? Good. So even though all these retail stocks are down from their all-time highs, there are a lot of major differences that are going on here. A lot of major differences, a lot of things that set AMC stock apart. I like what Mike Jackson said. He said they can't stand big money, smart money can't stand the fact that retail owns the real shares. And these shorts can't close their shorts even for a profit because they've sold so many fakes, so many synthetic shares. They have completely diluted AMC stock down, 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 down in price. But at the same time, retail investors have bought up the float many, many times over. And there are no fucking shares for the shorts, at least not anywhere near a sufficient number of available shares for the shorts to cover their positions. Only AMC can have great news on mainstream media, but the stock price still goes down. Only AMC was on the threshold securities list for over 50 days. Great point, guys. Only AMC has hundreds of paid shills on social media all across the world, teaming together to constantly bash the stock and the investors and people that are giving you due diligence, such as myself, to get us to sell, because they have no other option. None. And I still don't believe that the 40 million shares that AMC sold on September 13th, I still don't believe that the settlement has actually occurred for those shares. AMC sold them, but I don't believe that the market makers and the broker dealers have actually settled those trades yet. I still don't think that's occurred. Trey Edwards says, I took a chance on BBBYQ and my shares are still being lent out after cancellation. Ladies and gentlemen, I truly believe that BBBYQ is going to undergo a butterfly merger. I truly believe that. I've done a lot of due diligence on it so far, and I will do a video in the coming days of BBBYQ. And I truly believe that there will be a merger, and it will come back roaring at a much, much higher share price as well. Ryan Cohen is an absolute fucking stud. He knows exactly what he's doing, and I foresee some serious price action on those stocks as well. AMC, BBBY, etc. All right, let me keep moving on. I got more. I'm not done yet. Not even close. And why not? Because I came for the free money and I stayed for the financial reform, ladies and gentlemen. Warren Buffett holds long-term and gets idolized, and retail investors hold long-term and get blamed for the collapse of the stock market and teachers' pensions and firefighters' pensions, when in reality it was guys like Gabe Plotkin, Gabe Foreskin, and fucking, Virtue and Citadel and Susquehanna and State Street that bet against AMC stock and got short squeezed and lost all that money. This is to you. Cheers to you for coming for the money and staying for the financial revolution. Cheers, everybody. I do believe we're going to be so fucking rich. And this is not financial advice. I'm not a financial advisor. You can buy, hold, or sell anytime you fucking want. I'm not telling you to do anything. Do your own due diligence. I am just telling you what I've learned and what I believe. If you think I'm wrong, go ahead and sell. Do whatever the fuck you want. Don't buy any. I don't fucking care. I'm just here to share this information with people that I think are smart enough to listen and then go verify and figure it out for themselves. That's exactly what this whole channel is all about, is helping retail investors empower themselves. Period. Period. And you know what? Let's get an invite going here to everybody on YouTube. Let me get on this stream real quick. I'm going to drop you guys a link. You don't have to join, but I've got a free Discord with thousands of members in it right now, and that's what we're talking to you on right here. If you see my screen, I guess you may not be able to hear that right here. If you may not be able to see that, but everyone here, we've got lots of people chilling in here in the voice chat, and even more here discussing this every single day, talking about different meme stocks, silver, gold, commodities, Forex, you name it. You know, people are coming out with excellent information. Let me jump to Edward's post here because you guys have to see this. You have to see this. Edward Britchick, my guy, always appreciate it when he posts. Let me pull this up here and see where it's at. This was earlier today, for those of you that are unaware. So if you're wondering where those 40 million shares are and where the settlement of the ape shares has actually occurred, I don't think it's actually occurred yet. I think it's happening right now. And what I'm seeing on the market, I'm seeing that what is happening now greatly mirrors what happened in January of 2028. Sorry, January 28th and before of January 2021. And it mirrors everything that happened before the run-up of June 2nd, 2021. Now, I'm not sure how clearly you guys can see this, but what I'm seeing here is today AMC was shorted down early to 773, and then in a matter of minutes, between 10:30 and 2 o'clock, the price went from $7.73 up to $8.39 after having been shorted and being negative on the day. And then, as you guys may know, it ended the day down about 1%. How could a stock go from 773 up to 839? Meanwhile, the on-balance volume, meaning the amount that people are holding, is at all-time highs. On-balance volume is indicative of buying and selling. And if it's up high, that means that people are buying and holding. And if it were down low, that would mean that they were selling. But again, the on-balance volume remains extremely elevated. The price jumped up real high, and then the price was shorted back down to end the day in the red, and then it ran up again later in the after hours. This is exactly what I expected and hoped to see this week. I would have hoped we would have already run, but you should be expecting that manipulators will manipulate the prices to try to throw people off. They don't want people to think that this is a repeat of January and June of 2022. Here's an attachment showing the AMC OBV from Edward Britchick, right? This was 2021. Let me see if I can get this. Let me open this in the browser. There we go. Let me get this all on my screen so you guys can get a really way better look at it. Let's zoom in here. So this here is 2021, right here, this line that I'm at. And you can see the line was down low, and the number it was at here was at, that says 40 million. Okay, the OBV before the January squeeze was at 40 million. And then as retail started to buy it up, it rose and rose and rose, and the stock price of AMC rose from, you know, $1, $2 up to $13. And then it got shorted down, and people kept buying. See here? The price was still stagnating and getting shorted down, but people kept buying. They didn't sell. They bought more and more. That's the on-balance value. And then the price here at its peak shot up from $10.60 a share, pre-split price, to $79 a share in intraday trading, in intraday trades. Now that $79 a share was up 3,400% from its all-time lows in December of 2020 and January of 2021. 3,400%. I still remember, me personally, buying call contracts when AMC was around $11, $12 in May. I was buying June call contracts at the $40 strike when the stock price of AMC was still at $11. And those things were costing me $22. And every single one of those contracts, when I was buying them at $22, on June 2nd, 2021, they were worth between $6,200 and $6,500 per call contract as the price jumped from $12 a share a few weeks prior to $79 a share on June 2nd. I bought them for $22 and I was selling them for $6,500 per call contract. And a lot of other people were getting even more money because that was the $40 strike. Imagine what the people that had bought the $30 strike and the $20 strike and the $15 strike were selling their contracts for. I know some of you guys are in here right now I know you are. Right here in the chat with me. I don't know if you guys are in the Discord and you guys want to fucking talk about it. But I don't want to name names, but I know quite a few of you were doing that exact same fucking thing. Damn, did I close that shit out? Oh no, there it is. Here's my chat. A lot of people here were selling their contracts for significant gains. As you can see here, when the price reached 79, the on-balance volume did come down slightly as some people sold some of their shares. And then as the price came down, more people bought in and the on-balance value rose again. And then as the price has continued to go down, hold on, whoops. The price has continued to go down. You can see the price going down, 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 getting barcoded and naked shorted and rehypothecated. People kept buying more. And now, look at the OBV. Edward, this is a fucking beautiful chart as he zoomed in here on the on-balance volume. The on-balance volume's at 1.47 billion. And before the run-up in January, the on-balance volume was at 40 million. So we're reached an on-balance volume that we haven't seen since July or August of 2021. And it's reached those levels once again. This here is a key indicator to me. We've seen the fundamentals of AMC. We touched on them briefly just moments ago. And we saw that the fundamentals are looking strong. Their earnings per share are getting stronger. Their revenue is getting stronger. Their profits are getting stronger. Their net income is getting stronger. They're paying down their bills. They're coming out with all sorts of new revenue streams and so on. I can go on for an hour, but I'm not going to. And now we're looking at the charts and the on-balance volume proving to me that the OBV is at 1.251 million when it was previously at lows of 40 million, and it remains elevated over the last couple of years as retail just continues to buy more. That's wild, wild, ladies and gentlemen. As you can see here, the shares outstanding is much lower than it was in June of 2021. In June of 2021, when AMC went from $10 a share to $79 a share, there was around 550 million shares, I believe, maybe more, because AMC was issuing shares. They had just issued 43 million more shares out of the market, so it was somewhere in the 550, 600 million share range. Now, they issued APE. They have done a reverse split and a conversion of APE back to AMC, and then the reverse split of 1 to 10. Now there are only 198 million shares outstanding of AMC. The on-balance volume is about to break the all-time high right now, around 1.47, around 1.25 to 1.47 billion, according to this line right here, this marker on the chart. And there are around 300% fewer shares now than there was at that time. 300% fewer shares. That's right. Now, that same cannot be said for GameStop. I like GameStop. They've got great fundamentals. I think there's a lot of short interest on it still, and a lot of interest from retail investors. But the OBV is significantly lower on GameStop and has decreased, unlike that of AMC. The OBV on AMC, I'm down with OBV. Yeah, you know me. It's fucking high as shit. And this doesn't fucking lie. I mean, I didn't make this chart up. It just is. If you go look at it on the weekly time frame, you'll see it. Go look at it on the weekly. Go look at it on the monthly. You know, when in doubt, zoom out. That's all you got to do. When in doubt, zoom out. Get a good picture of what's going on. And when we zoom in, what do you see? I see naked shorting, naked shorted, naked shorted, barcoding, barcoding, barcoding. Boom! A jump from $2 to $17. That's what that was in January of 2021. And then naked shorting, naked shorted, barcoding, barcoding, barcoding. Boom! A jump from $10 up to $79. And now what I'm seeing? Shorting, 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 shorting. And then that price getting absolutely crushed, but the OBV is at all-time highs. Now, again, this is not financial advice. Do your own due diligence. But for me, I can see the fundamentals. I can see the technical analysis. I can see the short interest. And even the short interest isn't fucking real. Even the short interest isn't fucking real. Because that short interest is greatly diminished because you can't see it on Ortex data anymore. Let me show you what I'm talking about. I'm just going to go to my channel here and bust out this short 1-minute video that I did just a few days ago.
October 3rd, 2023, AMC.
Let me just move that over so you guys can see. This was October 3rd. It was 2 days ago.
Update. In August, AMC underwent a conversion, a reverse split, and received a new CUSIP number. When AMC received the new CUSIP number, all of the shorts positions transferred over.
Now, what that means is that all of your long positions, all of your shares transferred over to the new CUSIP. All your APE shares became AMC shares and then underwent the 1-to-10 reverse split. Same thing for the shorts. All those shorts transferred over and they underwent the 1-to-10 for the reverse split, but the value stayed the same. So if they had $100 million in short positions before the reverse split and conversion, they have $100 million in short positions after. The difference is that before the reverse split and conversion, AMC's short interest was 29%, and that was a different CUSIP number.
To the new CUSIP, but that data did not transfer over in Ortec's short interest estimations. That being said, previously it was at 29%, and now the new CUSIP is showing an additional 12.79% short interest estimate, which is an increase of 16%, which makes no sense because short interest can't really be negative.
See, it can't be negative, but as you can see here in green, the Ortex data shows that it was an increase of 16.45% for the day, but short interest was at 12.79%. Short interest cannot be negative. That's impossible, physically impossible. So how much is the short interest actually? At the time, they returned 950,000 shares, borrowed 10.22 million shares for a borrowed change of 9.27 million. That rose the average cost to borrow from 2.52% average to a maximum of 271.69% in a matter of minutes. Also, because of the old CUSIP number on Ortex showed 29% short interest, that is not taken into account on the current short interest on the new CUSIP number, because Ortex data doesn't take that into account. So what I believe is that the Ortex short interest currently being seen on the new CUSIP of 12.79 needs to be added up along with the short interest on the old CUSIP that existed immediately before the conversion and reverse split. That would put it well over 42%, and that is all self-reported data. Ortex only reports 85% of the data that's reported to the exchanges. And that data that's reported to the exchanges is self-reported by the broker-dealers, the market makers, and the shorts themselves to those exchanges.
In addition, they took out 10.2 million shares today towards the end of the day, increasing the cost to borrow quickly to 271%. In addition, prior to the split and the conversion and CUSIP number change, AMC had 29% short interest. You got to add that up with the 12.79% above, and that equals well over 40% short interest.
That's about it. I don't want to keep going over that. I don't like you guys video of me watching myself. That's kind of obnoxious. Do you guys have any questions for me? Look at GM says, I'm in since February of 2021 and I did not sell at all-time highs because fuck them, I'm still buying. We're going to be so fucking rich. This guy fucks. I like this guy. GM, you're badass, dude. Riding solo says, shorts are fucked. I'll buy more tomorrow. Darren Bowen says, D Nice, welcome to the Matrix, bro. That is badass. Christopher Chestnuts, no sell, no sell. I ain't selling till my fucking account looks like an international cell phone number. Badass. Bookman's looking for 40,000 a share minimum. Absolutely. What sounds that money printer make? Jerome Powell, get the money printer. Oh, get. Oh, that's fantastic. Darren Bowen is thinking that I think after 2 years we own the float 20 times over. I don't know, man. I don't know. And it looks like Black Widow's giving me an update on the bond market around the 10-year yield for the U.S. is at 4.717. Absolutely right. That is high. And actually, it's down slightly. Wait, 4.717. Let's take a quick peek at that. 10-year bond yield. It was at, yeah, there we go. 47.17, 4.17. Yep, down 0.18 today, which is not great. It's up 5%, up 10% in the past month, 43% in the last 6 months, 24% year to date, and 50% in the last 5 years. But as you guys can see, look at what was happening to the bond yields before the recession in 2006, 2007. And then here comes 2008, collapse in yields as the government started quantitative easing, printing, zero interest rates, fantasy. And then 2019, again, super low rates and yields as the quantitative easing was at all-time highs, and that's no longer the case. Now it's time for quantitative tapering, and I think it's time for this to go to a new all-time high. I do believe that the 10-year bond yield will be way higher than 5.2% and reach a new all-time high in the very near future. And because of that, the Fed will purposely crash the stock market. And because of that, margin calls will occur and highly over-leveraged stocks will have to be bought back. The volatility index, TBT, short, what is it? SQQQQ, AMC, GameStop, BBBYQ, MMHC. I think a lot of these fucking stocks are going to go to the fucking moon. And the higher the short interest, the more dangerous the stock. And remember, it's hidden short interest. It's not right out in the open. And that's the real issue that we're having. The bond market is a canary in the coal mine. And the more obvious that things are, the less likely that the government will actually see it coming. The less likely that the Federal Reserve will see it coming, because it's so obvious that they think they've got their finger on the pulse, and because of that, that lets things get away from them. That's what happened in the 2008 great financial crisis, and it's happened in the 2000 dot-com bubble, and it's going to happen again. This is Federal Reserve implementation of a stock market crash and an increasing in the valuation of the US dollar in an attempt for them to pay off their debts. That's it. That's it. The corporate action by AMC Theaters has been delayed by many clearinghouses, okay, and overseas. Check this out. Let me move this shit over. Overseas in Germany and Austria, there are still people that have not received their settlements. You know how when your AMC shares, you got additional payout of new AMC shares for every 75 that you owned pre-split, one for every 7.5 post-split that you own. Well, it's been over 3 weeks now, and guys like Tourist, CNARF83, asked their broker why the corporate action has not yet been completed. And the answer they got is because in the case of foreign dividends, the credit can certainly be several bank working days after the official payday. In the case of the above-mentioned joint stock company, AMC, there is a delay in processing. At the moment, we are dependent on the further action of our warehouse, clearinghouse, which carries out the dividend payment for us. Normally, the distribution will take place in the following days, and the dividend will be credited to your account. This is absolutely fucking huge, guys. Germany, Austria, Europe, probably fucking Asia, South America, who knows where else. And look at here. Look at this guy. DKB, a Deutsch broker, supposedly knew nothing and only responded after repeated email requests. Today, my AMC hashtag doesn't work for posts. These guys, they're brokers, didn't know a damn thing, and they haven't received it yet, and they're trying to figure out why. And look in Austria, Mo78. I'm a customer of an Austrian broker, and unfortunately, I received a similar answer. Still no shares, unfortunately. Ladies and gentlemen, the settlement of shares has not been completed. This guy got it from FlatX, and he did receive his, but this guy is with EasyBank. And he says, as I said, I've been in contact with the broker for over a month, and all I get is that due to the large number of transactions, no shares have yet been received from the depository. Holy shit, it's been a fucking month. We're gonna be so motherfucking rich. Oh my God. That's wild. Fucking wild, dude. Unreal. I got the same answer from De Giro in the Netherlands. Apparently, Goldman Sachs is investigating the issue. For all I'm asking, this is about, oh no, this is exactly what it is about. Even Goldman Sachs is investigating themselves and coming to the conclusion that they've done nothing wrong. Nothing wrong. Unfucking real. And, you know, other guys are chiming in. You know, I recommend emailing AMC Investor Relations so that they know about what's going on. And, yeah, that's a great idea. But, again, when you email AMC or contact AMC, the only thing they can tell you is to reach out to your broker because AMC does not control the stock market. AMC has no say in when your broker gives you your shares. If you haven't received your settlement shares or any of the sort, you have to pound your fucking broker. Email them, call them, chat with them virtually. Get on their fucking case and force them, Goldman Sachs or whoever the hell is the warehouse, the clearinghouse for these, to give you your fucking shares. Greetings from Italy. We just got you last week. It sucks. I mean the non-USA shareholders who own naked shares. What, dude, this is absolutely insane. Absolutely insane. That's why when I see things like this, when I see charts like this, I am not surprised in the slightest bit. And this, you know, if you go look at the GameStop chart and the OBV, I'm not even going to bother pulling it up right now, but it does not look like this. That's why, in my opinion, AMC has so much more potential than GameStop does for actual proper price discovery. I truly do believe that. Let me go through another one of my tweets here for you guys. Holy crap. Check this out. Asset Mark has been charged by the SEC for failing to disclose major conflicts of interest that led them to reaping massive cash profits. They are another Chinese finance company operating in the United States, and they paid a measly $18 million slap on the wrist. Of course. Now, you want to know about AMC shorts? Let's talk about AMC motherfucking shorts. Five entities alone have $2.1 billion invested in Trolucci Capital. Of that $2.1 billion, over 28% of their entire position is short AMC stock. That's $590 million worth of short puts. 3 out of those 5 clients are American companies, and 2 are foreign nationals, foreign entities, which have an equal 60-40 split between the 5 companies there, the 3 and 2 clients. It's as if these 5 entities are desperate to win big or lose big in this endeavor. And who is on the paperwork for this? Well, it's John Ackerley. He's connected via Trolucci Offshore Fund and based in the Cayman Islands. And Leanne Golding is connected to Trolucci as well, and she's a former vice president at Goldman Sachs before she went on to the Harvard Trust. She's also based out of the Cayman Islands. So the CEO of Cayman Islands at Carnet Group, John Ackerley. Leanne Golding, director of HTC Harvard Trust Fiduciary Services Committee. So it appears that the Harvard Trust and the Carnet Group may be associated allegedly, or their employees as independent directors of Trolucci Offshore Fund and Trolucci Capital Holdings of the 28% position of the $2.1 billion, which is $590 million. This is a massive risk, but as you know, I bring receipts. I always bring receipts. Here's the address and phone number for Trolucci Capital on their filings. Here's their phone number right there. I do not recommend calling them, but you can do what you want because you're an adult. Okay, this is kind of small, but I will read it out for you. Let me just open it in a new tab, make your life a little easier. So you can see, here's the a second other office for Trolucci Capital, 250 Park Avenue in New York, New York, Suite 1476. The location of books and records is held at Morgan Stanley Fund Services in the Cayman Islands. Now, more receipts. Here you go. Morgan Stanley Fund Services in the Caymans. Here's their phone number. Their books and records are kept in 2000 Westchester Avenue in New York. Here's their phone number. And as you can see, they are the large advisory firm for this as well. And the connection to the owners of Trolucci Offshore Fund is here, because now you will see that as they are, Trolucci Offshore Fund is located in the Cayman Islands. And the names of the general partners, manager, trustee, or directors are Leanne Golding and John Ackerley. Here and here. Based out of the Cayman Islands. The name of the private fund is Trolucci Onshore Fund. And the names of the general partners, manager, trustee, or director is Trolucci Funds GP LLC. So now we know that these 5 entities have a massive 28% risk, value at risk of their entire position of over $590 million worth of shorts against AMC. They have one office with 2 employees now out of a tiny shack in Puerto Rico. Jared Dubbin created Trolucci Capital January 13th, 2021. January 13th, 2021, just 2 days before AMC finished issuing their shares, but after they announced and began the actual share issuance. As you can see here, they have puts, 28% of their portfolio, 134 million shares worth on there, and a value of $591 million. That's different numbers here, not valid here, but you got Paul Michael Zecker as the new Chief Financial Officer as of April 2023, and Jared Ross Dubbin, which opened the company in January 13th, 2021. That was 2 days before AMC finished their share issuance, but after they had began the issuance of shares. Now, this is a master feeder structure that is used specifically to have a feeder fund in which there's a centralized master fund onshore and offshore. Hedge funds commonly use this master fund structure to accommodate U.S. investors and non-U.S. investors. That's exactly what we just got done explaining as well. And this allows funds to benefit from the pass-through tax treatments that they have here. And there are 5 funds invested here. Mainly, you can see the owners of the offshore fund are John Ackerley and Leanne Golding, per the documentation as well. Now, there you have simply one of many companies that was created just days prior to the massive run-up in January of 2021 of AMC, and they still hold that short position on AMC. Why do you think that is? Use your own deductions to think about why you think that is. Can they close their positions? If they do, where are they going to get the shares to do so? And if they sell those short puts and the stock price starts going up, what's going to happen to the other shorts? They're all going to hell in a handbasket together, and none of them can afford to let any of the others close out their positions just yet. Unfucking real. Now, as you guys can see here as well, Citadel Securities has had to collateralize $55.5 billion of their $63 billion in assets. If they default, the counterparties, the banks involved here, can seize all of their assets and margin call them. They can sell it or pledge it themselves. As of December of last year, the securities owned approximately $54.5 billion that have been pledged as collateral to counterparties on contract terms, which permit the counterparties to sell or repledge them. Why If they have 57.5 billion, why would they take 54.5 billion and pledge them to their counterparties unless they needed further margin? Huh. Gee, I wonder why, huh? So think for yourself, come to your own conclusions, do more research, okay? Because at the end of the day, I mean, these guys do nothing but mismark shorts as long, short exempts, and misreport millions of trades. September 22nd, not even 2 weeks ago, the Securities Exchange Commission charged Citadel for marking millions and millions of orders incorrectly. They marking short positions as long positions to keep themselves from getting margin called. They're marking shorts as short exempt illegally. They were charged only $7 million for this. As well as, on the same day, Goldman Sachs was found to have mismarked 163 million trades. 163 million trades on their blue sheets were found to have been marked incorrectly. And they received a $6 million fine. So if Citadel Securities was fined $1 million more than Goldman Sachs for their 163 million trades, that each single one of these trades had thousands, if not hundreds of thousands, or millions of shares in it, and options, how many hundreds of millions of trades do you think Citadel Securities marked shorts as long, cooking the books? This is what I'm talking about when I tell you that they're self-reported. The short interest is self-reported. They're marking the shorts as long and they're refusing to report it to the exchanges so that they can continue to short them without getting margin called. But eventually, as risk assets get sold off, as the bond market is required to be saved, well, margin calls will occur. That's been the thesis of this channel since July of 2021, and it has not changed because nothing has changed. I think we've gone on long enough. This is the second stream, has been also an hour and a half here as well. I appreciate you all for sticking here with me and for learning, and I hope you gained some value and some knowledge. If you did, feel free to like and subscribe, because I guarantee you I've got a lot more fucking info where that came from. I'm just running out of time. I don't want to keep you guys here any longer. I wish you peace and wealth. We're going to be filthy fucking rich. Have a great day, my friends.
Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker.
The sounds that money printer make cash.
Holy shit, we're gonna be so fucking rich.
Yeah.
Great. Damn it, we're gonna be so fucking rich.
Good night, everybody.
Griffin, I want my fucking money.
You're an original,
Hey,
aren't
yelling,
you?
give me the fucking money. Get the goddamn money printer out.
fucking rich. Get the goddamn money printer out.